Hello everyone, my name is Oyinye Ezanoche. So I'll be presenting depreciation calculations and determination of gain or loss. This presentation covers three scenarios illustrating different depreciation methods: straight line, double diminishing balance, and partial year depreciation with disposal. Okay, let's move on to straight line method. Leon Limited bought machinery for $37,000 with a residual value of $4,000 and a useful life of 10 years. Using the straight line method, depreciation is calculated as $37,000 minus $4,000 divided by 10, which equals to $3,300 per year. Each year, 2024, 2025, 2026, the company records depreciation expenses, $3,300, credit accumulated depreciation, $3,300. This method is the most simplest and most predictable. It spreads cost evenly, making profit and asset values easy to forecast. However, it assumes the asset wears out evenly. In practice, machines often lose value faster earlier on. We'll move over to double diminishing balance method. Now, let's look at the double diminishing balance method, which accelerates depreciation. The rate is 2 equals 1 times, sorry, the rate is 2 equals 1 over 10 times 20%, which is $7,400. In 2024, $3,000 times 20% equals $7,400. In 2025, $29,600 times 20% equals to $5,920. In 2026, $23,680 times 20% equals to $4,736. Journal entries each year debit depreciation expenses and credit accumulated depreciation for three amounts. This approach recognizes that assets are most productive early in their life. It also aligns expenses with higher internal revenues, offering a more realistic expense pattern. It reduces early year profits but provides better matching of costs to usage. Okay, so we'll move over to partial year depreciation and sale. In this case, the machinery was bought on October 31st, 2024. So only 2 months of depreciation apply in 2024. Annual depreciation, $3,300 times 2 over 12 equals $550. That's in 2024. Then $3,300 in 2025 for the full year and $825 for 2026 for 3 months before sale. Total accumulated depreciation before sale equals $4,675 thousand dollars, leaving a carrying amount of $32,325. The machine was sold for $28,000, creating a loss of $4,325. Disposal entry: debit cash is $28,000. Debit accumulated depreciation is $4,675. Debit loss is $4,325, while credit machinery is $37,000. This scenario highlights how partial year depreciation ensures fairness in reporting and how disposal accounting determines gain or loss. In conclusion, depreciation methods shape profitability, asset valuation, and tax planning. Choosing the right method ensures fair reporting and strategic financing management. Thank you for listening.